Hey traders, welcome back to another video. So it's been a very long time since I posted any technical video on my channel. So I thought of, hey, why not let's do quite an important lesson where I don't think many people talk about because most of the people online, they just talk about strategy, they talk about risk management, but no one really tell you what are some of the important things that really helps you to prevent yourself from overexposing or over trading or over risking or revenge trade a specific trade idea. Alright, so these are some of the 3 simple criteria that I teach the 1% Trade Club traders. These are just some of them. Okay, we got different criteria, but yeah. The first one, setting a final defense line. So what does it mean by setting a final defense line? Very simple. So let's say if today your thesis in the market is you want to go short. Let's say market drops down, 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 and it breaks lower. Okay, so now the entire trade idea is I would like to look for a continuation short to the downside. I'm just looking to sell this. All right, your setups could be as simple as you want to trade a break and a retest of the price structure. So let's say you go short here, you go short and stop loss above the minor swing high, targeting this to the downside. Very simple. Most of the traders trade these ways as well. So what if price stops you out? Stops you out. Okay. So you are now not allowed to sort of get back into the trade and just see what market really does. A defense line means where is the bottom line that you will give up on this trade idea. All right, again, the topic of this video is all about how do you manage overtrade. So let's say if it get stopped out on here, what do you think majority of traders would do? They will start looking for a re-entry, which goes to our point 2. So defense line, point 1, refers to this is your bottom line. Your mind is clear. You say, hey, as long as price is under these swing high zones or resistance zone, this is on a seller's market. Simple. So let's say you take a break and retest here and you get stopped out, you are not allowed to get back in. But at the same time, you got a defense line there saying as price is still under that resistance, is still a seller's territory. So you are not re-entering, but you know sellers are still possibly there. Most of the traders, what they do is they see price comes up, either is this area or this zone here, they start blindly going short again. And that's what I refer to not knowing when to re-enter a trade, when to not re-enter a trade. Alright, I'll give just a simple logic. Today, if your initial setup says that my stop loss will be placed above that mini swing high, you set your stop loss there for a reason. The level must be sensible as well. So if let's say you get stopped out and you start chasing a second sell, or potentially if you are revenge trading or tail trading, you might even chase for a third sell. So these 2 subsequent shorts basically just show how indisciplined you are. You are already, the setup itself, price action itself has already told you that things is wrong. That's why you set your initial stop loss there. If you start going short above the previous SL or somewhere around there, what you're trying to doing is, this is what you're trying to do. Make sense? Right? Really simple thing, but most traders don't seem to understand why, because these are not commonly just being educated in the public. Alright, and in fact, I have not seen anyone talk about this kind of topics as well. It's such a simple but yet important lesson to make sure you don't overtrade, you don't overexpose or over risk on just one thing. That's what we call directional bias. When you keep blindly going short into one trade idea, it shows that you got zero consistency. Second thing, you don't really have an edge, you don't have a system. Third thing, you are not sort of measuring, you are not limiting your net risk exposure on one trade idea. Because whether if it goes short here, get stopped out, some traders will say, oh, as long as all of them have a fixed 1% risk, I'm still sticking to my risk management. No, this is not risk management. Risk management is about knowing when to stop trading and when to trade. Alright, that's risk management, simple. So if today you just short it here, get stopped out, short it here, get stopped out, short it here, get stopped out, you basically risk 3% on the one same trade idea. What's the trade idea here? What's the thesis? Is you're anticipating a continuation short to the downside. Alright, so I hope this makes sense of point 1, point 2. Having a defense line allows you to have the peace of, I know sellers are still in control, but I'm not going to trade. This is what we call a defense line. You know sellers are still in control again, but you are not rushing the process. Alright, you get stopped out once, you step away, you wait for the market to decide whatever it wants to do, you just step aside. You go fishing, you go whatever. Second thing is limiting the number of re-entry, tightening your criteria. Do not re-enter into the trade until price proves you right. So I'll give all of you an example. So let's say same price action, alright, same exact level. Under what circumstance can you go back into short? So if let's say price does this, you get stopped out here, alright, you get stopped out at the here and price goes up. Can you go short here? No. Can you go short here? No. If price comes all the way back down, can you go short here? Yes. That's what I refer to limiting the number of re-entry, because you need to understand one thing. Market is a very probabilistic thing. Alright, the more you're being biased, the more you're being glued to one specific trade idea, your entire price action reading, your entire logical sense, objectivity, everything's being clouded. You are just so focused on I want to sell, but you start ignoring the fact that market can reverse into an uptrend. And that's why a lot of people, when they go short, get stopped at once, twice, thrice, they remove their stop loss and then they blow their account. Alright, let me know in the comment section if you have ever experienced this, where you lose 1 time, 2 time, 3 time, remove your stop loss, and guess what? Market completely goes into an uptrend. This criteria 1, 2 is to ensure that no matter how confident you are on one trade idea, you have full clarity, you know exactly what you're doing, but you are not overexposing, right? Because you know when exactly should you trade and not trade. So mark up your territory and say anything under this level is seller's territory. Anything above this level is buyer's territory. So you will not be reshorting until you see price close back under the support and you go short there. That's just how simple it is. Alright. Point 3. Setting a max risk per trade idea is very similar to what I just taught all of you. Point number 1, point number 2. But point number 3 is more to a specific number. Alright. Each trade idea I'm only allowed to lose 2%. Example. So what does a trade idea mean? A trade idea simply mean, let's say today you want to go short on pound dollar. Alright, you're expecting what? You want to go short, it's one thing. Second thing is you want to look for a continuation under $1 mark. So assuming this is $1. This is $1, this is $1. That means your thesis today, if as long as you're going short, it is the same trade idea. Alright, so I don't care if you short it there, I don't care if you short it there, I don't care if you short it in between, out of nowhere. As long as you go short, it is the same trade idea. So what you can do is simple. Say I'm going to risk a max of 2% per trade idea, which means I'm allowed to go short once if I get stopped out. In case if it comes all the way back again, I'm allowed to go for a second sell, because market again proves me correct. Because not every single time you're going to get the perfect turning point, the perfect timing. Some of the really good trade idea, it does require 2 to 3 attempts, especially if they are mean reversion in nature. It might require 2 to 3 attempts to really get that turning point. But the key thing is, are you really having a plan, or are you being stubborn? Are you being egoistic or biased? Alright, you need to know how to differentiate that. So that's pretty much it for this lesson on how to make sure you don't overtrade, how to use 3 simple criteria to make sure you control the number of re-entries, setting a defense line. Alright, and I'll talk to you in the next video. If you like, please don't forget to like, share, and subscribe. Let me know in the comment section below if you learned something new, and I'll talk to you next time. Oh, before I close it, I do run a trading community called the 1%ers Trade Club. If you're interested in joining us, we're still looking for more dedicated, serious trader. No BS here, pure education. You'll see all of my exact trades. If you're interested in joining, link is in the description. It's called the 1%ers Trade Club, and I'll talk to you next time. Bye bye.